Hi and welcome to the Stockercade's Dividend Assessment Series. In today's video, we will have a look at IBM's dividend safety following their fourth quarter and full year 2020 earnings. Both the revenues and earnings have seen declines for the full year 2020 and the fourth quarter compared to the same period 1 year ago. IBM, which is also known as the Big Blue, has product and service offerings which include the segments Cloud and Cognitive, which made up approximately 32% of its 2020 revenues. The Global Technology Services with 35%, the Global Business Services with 22%, and the remaining segments which collectively made up approximately 11% of IBM's annual revenue. But without further ado, let's have a look at the dividend safety metrics for IBM. Primary scores are: Earnings Payout Ratio 103.8%. IBM is paying dividends in excess of its earnings per share, score -1. From a free cash flow point of view, the dividend looks safe with a 39% payout ratio. Score 2. Return on invested capital, 7.4%, score 1. Net debt to EBITDA. IBM's net debt to EBITDA ratio is relatively high with 4.2, score -1. Operating margins versus industry, with a positive 1%, IBM is within industry average, score 1. Dividend growth years. IBM has become a dividend aristocrat, having raised its dividend for the past 25 years, score 1. Before we go ahead with the scores, please consider subscribing and hit the like button, so that these videos find their way to viewers for whom such information may be of help. And the secondary are: 5-year average EPS growth, negative 14.8%, score 0. 5-year average sales growth, negative 2.1%, score 0. Average analysts' estimated EPS growth next year, 9.6%, score 1. Average dividend growth past 5 years, 4.6%, score 0. Dividend in market downturns. IBM has raised its dividend during the financial crisis as well as during the COVID market downturn. Score 1. S&P rating, AN negative outlook, score 1. IBM's total score is 6. This makes it a 2-star dividend stock in our books and is to be monitored very closely with regards to its ability to continue to keep the dividend at current levels in the foreseeable future. Even though free cash flow easily covers the dividend and the dividend yield looks compelling, the lack of growth or even downtrends in revenue and earnings are a concern. Looking at the share price, it has been on a steady downtrend since its peak in April 2013. Massively underperforming the S&P 500. The company is trying to catch up in the cloud business. It is also involved in blockchain technologies. In October 2020, IBM announced that it intends to spin off its Managed Infrastructure Service unit into a new public company in order to focus more squarely on its hybrid cloud business, which includes Red Hat, a company acquired in 2019. The two companies are expected to maintain the combined dividend level after the separation, but it is not clear yet what share of the dividend IBM will hold after the spin-off. Following the spin-off, IBM will transition from being a company with half its revenue in services to one with more than 50% of sales from recurring revenues. The spin-off is expected to take place by the end of 2021, and we may reevaluate a possible investment in IBM following the corporate action. Thank you for taking your time to watch this video and see you next time.